Hi guys, welcome to a new episode of Let's Talk. This is Akim. My name is etc. on eToro, and I'm with my co-host Dimitri. Dimitri is also a popular investor on eToro, and we have a very special guest today, a friend of ours. It's Max Molter. While we have Max on the line, I wanted to discuss a little bit your strategy. I mean, this is a bit outside the airline topic, but if you can tell us a little bit about your strategy, and then we can understand also why airlines are not part of your strategy. To be honest, I follow you since some years. Yeah, not since some years, since some months, since we met in Abu Dhabi, in end of when was it? End of October.
November.
And I don't exactly understand your strategy. It looks complicated. You have instruments that other investors usually don't use or rarely use. And so can you explain to me? Because I'm a finance professional. Dimitri also invests since years now. Um, and your strategy is fairly complicated for us to comprehend. So imagine all those new people on eToro that perhaps are not that experienced. They will be like, this is all hieroglyphs. What is he doing, this guy? But somehow he's managing to have green returns, positive returns, practically every year, actually, from the 5 years that you're on the platform.
Yeah, please explain because I get confused too when you talk the technicalities. I get confused too. I'm not doubt that you know what you're doing, but just explain to the people what exactly is your strategy.
Okay, basically, I would say I have three big strategies. One is basically trend following. So this is the huge SPXL 3 times leverage S&P position. And basically, I'm in the market when the market goes up. So I do that by using moving averages. And then when it drops under the moving average, I simply go out. And it basically works because you can look up the historical volatility under the moving average and above the moving average. And above the moving average, it's far lower, so you can use the leverage. And under that, you have like 2% per year in returns still that I miss on. Of course, because of the volatility, the ETF would perform a bit worse. So I probably miss 1% of volatility or returns there. But I clearly reduce my drawdown because yeah, after this point, I'm complete out. So if the market drops 10%, I might get losses of 6% because it's 20% of my portfolio times 3 times leverage. But then I'm out. So then every crash can come and I will not lose more money on that.
So you would define yourself as a purely technical trader, actually, and not an investor.
No, it's just this one strategy. They're
So you have two more
basically completely
strategies,
different.
right?
Yeah, they're completely different to better diversify. Because if I would use only trend following approaches, then they would be correlated.
Yes.
And then I could easier lose money.
So one strategy, trend following, technical, right?
Yeah.
You have two more strategies.
Yeah, 2 or 3, depends on how you see it. But then I have a gold strategy, which is basically I buy gold every week at the same time, and every week at the same time I sell it. And this basically makes money because it takes advantage of seasonality. Because without going too much into the strategy, it uses the idea that that industries buy precious metals over the weekends, so they are shipped over the weekends, and on Monday they have them. And this, of course, creates demand before the weekends, and you can basically profit from that. So this is one other strategy. Then I have a bond strategy because somehow I have to manage my bond positions.
But the bonds, how do you do via eToro? Because there are no bonds listed there. Is it through ETFs?
Yeah, it's through 3 times leveraged ETFs on 20 years. So the most
Is that
volatility
the
you can get.
TMF, right?
Yeah, that's TMF, and I use a 2 times leveraged one for shorting them. That's TBT. It's another ETF.
TBT. Mm-hmm.
Yeah.
All right. And you probably have also a stock picking strategy or not, because you have
Yeah, exactly.
quite some stocks in your portfolio. So that would be the fourth strategy. And you
Yeah.
focus more on tech or?
No, I actually the idea is when you think about stocks, what would be the perfect stock you want to have? And there are basically two ideas. Some say you want a growth stock that's rising fastly, and some say you want to have a value stock because it's cheap and undervalued. Now, the idea of the algorithm I'm basically using is that you search for momentum. So I only select companies that have good momentum over the last 6 months. And then from those companies, I pick the cheapest ones, basically. So you have undervalued companies that are rising. So the market, or someone at least, has recognized that those companies are undervalued, but still not enough people have recognized the fact. So it's still cheap. And the idea is basically with the company rising, the company gets more and more attention. More and more people are drawn to the conclusion that it's undervalued. And that's why it continues to go up. And
cheapest by which metric? Price to earnings?
Price earnings, price sales, it's a mix.
Okay.
I also use of I forgot the name of the little book that beats the market. It's a hedge fund manager.
Yes.
Yeah.
Yes.
He has also a value metric for that. And I use that too.
And do you compare with competitors or with historic valuations?
No,
of the
simply
stock in
plain
question?
the valuation. So, for example, I would compare PE ratios across all sectors without finance sector, because the finance sector is often
Yeah, but
often
energy is always cheaper than tech, for example.
yeah,
And
but if
tech
it
has
rises,
always,
then that's fine for me.
if it's on a
It's based
rising
on
trend.
statistics, so it's back tested basically.
And what is your benchmark then? Do you have a benchmark, or is your benchmark maybe the inflation rate? You just want to beat inflation every year? Or do you have a specific, because it's difficult to have a benchmark when your portfolio follows several strategies and is somehow I don't know how to describe. It feels like your portfolio is a jellyfish. You know, a jellyfish. It has tentacles that go right and left and front and back and tries to catch fish like that, right? That are a bit uncoordinated, the tentacles between each other, in a way uncorrelated. And this is their way to be able to catch fish without having a brain or eyes. So now don't be offended, but is that the purpose you have? And if yes, how do you measure your own return? Is it do you measure it against the inflation rate, or what do you like to use to know whether you're performing well or not?
Well,
Maybe in relation to the risk that you incur, do you measure the level of risk from a risk adjusted basis? Perhaps you're satisfied, or how do you know that it's optimal, your portfolio is optimal?
well, I think you can't really know if your portfolio is optimal. I mean, you can make an educated guess. And of course, finding a benchmark is problematic. My overall goal, I would say, when I founded the portfolio is to have S&P-like performance in the end. I'm not there yet, but over the last year, I made good progress. I think over the last year, I'm almost equal, but by having far less risk. So you will see, for example, during the 5% drawdown we recently had, my portfolio was down less than 2%. So that's
yes. For example, just to take statistics, because our audience doesn't necessarily have it in front of their eyes. This year alone, so the 5 months you take this year, you had 4 green months, and the only red month was April, which was a difficult month for everyone, and you had only minus 0.8%. So
Yeah.
practically you managed to be flat. So based on the returns, and this is not just for this year. Every year you practically manage to avoid every time losses, even on monthly basis. So it seems that what you care the most about is drawdowns. You want to make sure that you don't lose money, and at the same time you manage to beat inflation. So overall, your wealth has been growing in the last 5 years in a very safe manner.
Yeah, I mean, for some part it could have been a bit more aggressive. For example, last year my performance is terrible. I made like point something percent,
It's
which,
still green.
yeah, but it was mostly due to a mistake, basically, because I didn't have the strategy with the moving averages yet. So I didn't find a good entrance, and that fucked up my complete performance. But yeah, in the end, my goal is simply to have a relatively low drawdown. And that was
Mhm.
my goal from the beginning, because I thought when I manage a portfolio for other people,
Mhm.
the very most important thing for me is not to lose money for them.
Yes, to preserve their
Yeah.
wealth, right?
Yeah.
And
But
then you always will have time to grow. I have one
exactly.
one question, but I will let Dimitri go first.
So Max, are you green in every year so far?
No, in 2022, I was down 0.16%.
Okay, so you were green every year since, because that was the bear market. The market was down 17, 18%. So is it your strategy, and Akim as well, because Akim has been green since the beginning. He didn't have a down year. So basically, you both guys running absolute returns portfolios that you make a profit every year, which is like a completely different strategy and really hard to do.
Yeah, I mean, yeah,
You know,
it's
That was the intention.
yeah,
That was the intention in the beginning,
Max
or
is Max lives maybe 30 kilometers from me. So really just across the border from Luxembourg in Germany. And we both maybe we're structured in a way, in a similar way. We live in a region, so Northern Europe, where demography is not very dynamic, where we don't have much inflation historically. We don't have much growth neither.
Mhm.
So anytime your portfolio performs higher than 0%, it's a pretty good return already.
Hmm.
We don't have the same, maybe we don't have the same pressure as US people have. The people who live in the US, they need their portfolio to perform well every year in order for them to get their retirement 40 years from now.
Mhm.
But Max and me, we essentially have guaranteed retirements. And all we need to do in the meantime is to make sure that the wealth we accumulate through work, that we manage to preserve that wealth in the meantime. So to make sure that we don't burn it. So perhaps it's related also to this that Max and me, we both in a way fairly conservative. We don't want to lose money. This is really the first thing that we always say. I always tell you, Dimitri, my first thing is I don't want to lose money, my money or from my copiers. I manage the portfolio of my mother as well, so I want to make sure I'm not losing money. Otherwise, I'm in trouble. And but we manage it in very different ways. In my case, I really focus on stocks with that are undervalued with growing earnings. In the case of Max, there are several different strategies, and actually, this comes to my question: is that from the four strategies that you mentioned, one, stock picking; second is gold; third is the trading, technical trading; the fourth was the bonds. Which one from those four aspects um, give you the most comfort or give you the highest returns or that you prefer? Let's say that if you had really no choice and you had to stick with one single strategy for the whole year or for the next 3 years, let's say, with which one would you stick?
definitely with the stocks one. because it's based on a strategy that I've found in studies, and it's back tested back to 1927 through the Great Depression, and it averaged 26.7% a year
But
until now.
this is a huge surprise because you don't have a single stock that reaches even 1% of your portfolio. I'm talking at cost. You don't have a single portfolio
No, I mean
where you invested more than
I mean the
1%.
S&P, the leveraged S&P. I'm sorry.
Ah,
I mean
so not
because
stock
I see
picking.
that stock position because the stock picks are averaged out by short positions, so it's basically market neutral. And the S&P position is basically my whole beta exposure.
So the technical trading of the S&P, right?
Yeah.
Times 3. That sounds risky, actually. It's not someone who wants to preserve wealth that goes times 3 on the S&P.
Actually,
A priori, I mean, the first impression you have, if someone tells you, I want to preserve all my wealth, I'm going times 3 on the S&P.
Yeah, but then you see the level of volatility of his portfolio, and it's not that much volatility in his portfolio. I mean, if you see the movements day in and day out in up markets and down markets, his portfolio is not volatile. So it sounds risky, but it's really not. It won't have too much upside either, but it's not risky at all. It just sounds risky.
Yeah, I mean, it's much risk, but it's balanced out by another leveraged much risk position that's negatively correlated, basically. And actually, it performed quite well. I mean, during the last 6 months, I made 16%. If you, I mean, straight 6 months. I'm up 16.6% in that half year.
Okay, so you said you have the stocks triple leverage, and then you have something that is not correlated. We're talking about the bonds.
Yeah.
So they're not correlated in regular times. But when something serious happens, all the correlation goes out of the window and they all go down together.
No, because the bonds trading switches between long and short. So historically speaking, the trading system was really good in finding which position you should enter before a crisis happened. So, for example, during 2008, you would be long bonds.
Yeah.
And then basically all would go down at the start together, but then you would be stopped out of the S&P position. So you only have the bonds, and then the bonds would rise up. You don't have the S&P position that goes down further. So you're basically flat after that, and then in the rebound you can re-enter the S&P with the strategy.
So initially they go down together, and then initially they go down together. They go down together, the bonds and the stocks in a time of crisis, and then the bonds they start going the other way, and the stocks continue to go down. Correct?
Yeah, most of the time.
I
mean, the strategy is based on the movement of commodity markets in relation to the movement of the stock market. So when you have an inflationary crisis, basically, and commodities outperform, you would be short bonds to hedge the interest rate risk. And if you would have a deflationary crisis like 2008, where commodities fall with the stock market, then you would be long bonds to secure that field.
Yeah. So do you have to babysit the portfolio? Like,
yes, how much time do you spend taking care of maintaining that portfolio? Because it sounds really like a lot of things to pay attention to. Dimitri and me, we both have overall we have one single strategy, I would say, and we can review once in a while. But yours with 4 strategies, as I said, jellyfish, no eyes, no brain, lots of tentacles. Do you have a lot to monitor there?
No, actually, I have so much free time if I don't spend time on researching better strategies. I mean, every day at the start of the market, I look at the indicators for my S&P position, and then I change the position if it has to be changed. And that happens every 3-4 months. So
But you look every day, right? You go, you look every day
yeah,
when
at the
the
start of the market.
opens.
I mean, I look at the monthly performance of the S&P and at the monthly performance of DJP, the commodity index, and that's it. For gold, I have to make one trade one time a week.
1 time a week.
For the bonds, I have to look at the start of the week, so it's weekly, and my stock positions are revised at the start of each year.
So how many trades a week?
Wait, gold open, gold close. That's one.
Yeah.
Then maybe the S&P, but again, it happens. It happens
The balloons.
like I said, a few times a year, and then maybe one bond trade. But again, that happens once a month, maybe. So I have less than 2 trades a week on average, I would say.
So Akim, please, when he's describing his strategy, it sounds risky, but it's really not. When he's like 4 strategies, it sounds like he does 20 trades a day, but he's really not. So you know what I mean?
Yeah, this to some extent is a bit of a surprise.
It is a surprise, yeah. Even though he explained it before.
How did you come up with this overall construction, Max? Did you just read some strange book and you decide to follow that, or what's the process here over the years to come up with those 4 strategies?
Well,
I
basically,
assume that took a lot of reading, also based on the number of books you have in the back.
yeah, of course. No, my basic problem was.
By the way, I see 4 shelves, right? Is it 1 per strategy or?
No, sadly not. I've got even more. You just can't see it. 6 ones. But no, my main problem during 2023, so during last year, was that the rally had started in October again, and I wasn't in the market. And then I entered the market went down, I thought it's a bull trap, I got out again, and I made losses. And that's where I realized I have to have a plan beforehand, and I have to find some way. If I want to mitigate my market risk, I have to find some systematic way to go out of the market and to go in again. And basically then I found the study about the leveraged S&P position, and I thought that's perfect because you basically have similar drawdowns to the normal S&P because you get out so early. And then I've read Nassim Taleb, and he talked about the barbell strategy. And the idea is, if you can't measure risk accurately because correlations are not stable, you have to always think that your investment can go down to 0. So instead of picking investments that you think are mid-risk or low risk that could turn out to be high risk in the end, you should instantly pick a high-risk strategy, only use a part of your money, in my case is 20%, and then you have still good returns because it's so risky and it's so leveraged, but you can't lose more than those 20%. And that's how that developed. And then I read more books on stock picking systems, and that gave me my stock picking ideas. And the bond system was actually completely my idea at that point. So I just had, I guess I back tested it. It worked. I tested its statistical significance, and then I used it.
Yeah, I have one more question for you actually, but maybe Dimitri, is there something you want to add something, or should I go with the question?
I'm just listening, even though
because you look puzzled, to say the least.
No, I'm not puzzled. I'm just thinking that you're just saying that he made a mistake last year, and then he added something to his strategy. So his strategy is still evolving. You go through your experience, you see your mistakes, and then you're adding something to it. You try to make it better. But yeah,
in relation to that, and maybe the question is a bit provocative, but over the years that you have had these strategies and that you've been working on them and improving them, did you not feel that you were lacking of sexiness? By that, I mean, is the performance just too reasonable, too maybe rational, too in a way perhaps too safe? Because a lot of people go in the market, most of us really go in the market with the idea of building wealth, right? But we all go also with a little bit of a certain kind of excitement that, of course, we have to put aside when we review the assets that we're picking. But overall, there is, it's normal to have emotions, right, in the stock market. So, do you never feel like there's a lack of emotions when you're working on your portfolio? Because you're not trading much and you're following statistics, so you're following numbers and charts. Um, so not real business cases behind those assets. Um, it doesn't require much creativity or imagination, right? So it uses a certain part of the brain that is very mathematical, if I can sum it up. Do you never feel that you need to involve somehow the other part of the brain, the one of creativity, maybe imagination, maybe greed, maybe hope, maybe it's provocative on purpose.
No, it's good. I mean, I've always been a more of a mathematical minded person. So I always liked that. And
So that's
actually,
your
I think it's,
competitive advantage, right?
yeah,
Versus all the other market participants.
I would say so. And I think the biggest competitive advantage of quant trading, so systematic trading in general, is that you don't use emotions. Because emotions most of the time will cost you dearly. And yeah, I mean, sometimes I thought that my strategy wouldn't yield enough. That's basically why I introduced new ones and new risk and stuff like that.
Did you
But I've
ever
always,
have days where you were like, oh, it's not for me? Did you ever
no,
have a moment like that, saying that I'm not gonna make it?
no, not really. I
So you
mean,
always knew that it was systems that you could improve, right?
yeah, I mean, I always had the idea of building a solid foundation, with which I mean that I don't make big losses and that I can build on that. And now that I've made like 16% in the last 6 months, I feel like I can get good enough returns. But I've never got this problem that I felt, oh, I'm not gonna make it, because I mean, if you look at the stats page of eToro, for me, my biggest weekly drawdown in the last year was 2%. I've
Mm,
never been down more than 2% in a whole week.
this is impressive.
Yeah, so I don't have those phases where the portfolio goes down 10% and I think, oh, another red day, I don't want to look. So, and if I plot my portfolio over the long term, I can basically see if I do it yearly, I can see a straight line. So
A
I'm quite
straight
happy with
line
that.
up and to the right, right?
Exactly. Yeah.
Mhm. And this is what matters in the end. This is what we're all looking for this line that goes up and to the right.
north
Yeah.
and west.
Yeah. I mean, I think
Dimitri?
I'm on. Yeah.
Sorry, Dimitri.
Just looking for myself. So no, I'm talking north and east, the
Northeast.
line, yeah. So okay, so the question you asked, Max, do you second guess yourself sometimes, Akim? Are there days that you thinking, okay, because sometimes just things happen. Three stocks in your portfolio go down at the same time, the same day, which never happens. And then I'm not saying I'm not gonna make it. Maybe if you're thinking, oh shit, this is bad luck. Why did I get that? Which I believe is normal for an investor to think like that sometimes. So do you?
I have something like that practically on a daily basis where it's there's like an internal struggle going inside my head where you have two Akims that fight each other. One is one that wants to have a beta below one, and the other wants to have a beta above one. And the one that has a low beta always wins. And there's my internal struggle. I always want to increase my beta because I don't go down much and I don't go up much when the markets go down and when the markets go up. So of course, when the markets are down, I'm pretty happy. I have a lot of cash. I can reallocate, benefit from that. And when it goes up, it's trailing a little bit. Unfortunately, it's maybe just who I am. And I think when you invest, in the end, the strategy that you have reflects your own personality. So for example, for Max is someone I mean, I obviously don't know the personality, but I can assume that it's someone pretty organized. Also based on the background, we can see the room, very clean, very organized, very structured, and the
You don't
portfolio
want
is
to see the
also
whole
like
room.
that. At least the background. And the portfolio seems to be also very square, very mathematical, no emotion, right? From that perspective. In my case, I'm pretty slow person when I walk, when I talk, and my strategy is unfortunately also a little bit slow. So I have slow returns when the markets go down and up, and I permanently try to add riskier assets. I'm just not able to hit that buy button on risky risky assets. I just cannot bring myself to do that, and I think it's related to the personality in the end. Probably we should make an episode about this with Dimitri as well. That an investor, the investment strategy of an investor very often reflects really the personality of the investor. In the case of Dimitri, I know he has big dreams, big ambitions, and this is the assets that he really chooses, the ones with huge potential. Of course, they're riskier than I mean, his strategy is riskier than Max's or mine, but this also reflects his personality, pretty ambitious and looking also for something big. And it's either you go big, you go home. This is from what I can tell about Dimitri for the months that we know each other.
Yeah, because you know what? You said that me and Max, we live 30 minutes from each other. We live in Northern Europe. And you describe your situation, yours and Max. In my case, it's the years that I lived in the United States. Those 10 years, they added something. And when I was in New York, I was at the mecca of the stock market. So probably that affected me is go big or go home. Beat the S&P. If you don't beat the S&P, just buy the S&P. So that's the mentality I started the portfolio. But you guys run absolute returns portfolio, which is it's extremely hard to do. Even people that have low risk, they don't get spared by bear markets. They usually go down with the bear markets. You guys did a good job in 2022 and were positive. So there's something to that. You can't compare. Not everything is equal, you know. But I told you, if you want to increase your beta, just buy Tesla.
I just cannot buy Tesla. We've
Me
discussed
too.
this at length.
It's going to fix the beta problem in a minute.
I know that if I leave you my portfolio, if I give you access to my portfolio for 5 minutes at the market open, I will see my beta double. Yes. All right. Max, do you want to add another thing? Perhaps why should a person copy you? And we can conclude on that. We know the differentiating factor, right? We discussed about it. Your strategy is very unique. Why should a person copy you, or what should be the expectations of this copier to copy you, Max?
Well, I mean, everyone who wants to invest in the stock market and get a decent return, I would say, but has lower risk tolerance, or who needs the funds. Somebody might need the funds in, for example, 2 years, and you simply can't afford to be down 40% in 2 years. So I think this is an investor group that's definitely somebody that could copy my portfolio. And also, I mean, I try to improve the returns all the time. So I might have someday 10-15% on a yearly basis. I mean, at the moment, it works like this, or in the last year.
Mm-hmm.
But of course, you can't guarantee anything. But I just think, yeah, you can't see how things develop, but I'm permanently striving to further develop the portfolio so that it's still low risk, but that the return goes up over time.
And absolutely. And I think that for an investor, it doesn't need to go all in your strategy, Max. I think that an investor who has 10K or 100K, for example, can invest a little bit on Demetri, high beta, on mine, let's say more or less like a medium beta, and on Max that has a very safe strategy where you don't have drawdowns and you have quite consistent returns. I think it makes absolute sense for a copier on eToro, for an investor to put some money on different portfolios, and at least you have one portion of the portfolio that you're practically sure will not go down by copying Max. Another one that you can have big dreams by copying Dimitri. And I think ultimately this is what investing is about, is if you don't know what assets to pick, at least you can pick portfolio managers. And this is the beauty of eToro. You can pick different portfolio managers who will do the work for you, because it's our respective passions and happinesses, and we are different. And we all have a very good track record for the past 5 years. And guys, thank you for listening to our episode. Max Molter, our special guest. And this show is called Let's Talk. We are on Spotify, on Apple Podcasts, on YouTube, on LinkedIn. We're everywhere. We're on eToro. So make sure to follow, subscribe, rate us, send us your comments, your questions. If you have questions to Max, you can always put them in the comments and we will forward them to Max. So thank you guys for listening.
Thank you, guys.
Thank you.
Thank you.